High-flying Netflix is down 59.26% today, according to Google Finance, at $224 a share as I produce this video. The problem with sites like this, however, when you look at Netflix, you see that if I look at it long-term, it's been a high flyer and then recently has collapsed. You don't really get a perspective of why. So in this video, I'm going to talk about why Netflix is down and whether or not it has further to fall. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. And, we all, I'm sure by now, have seen what's going on with Netflix. It's been, really extraordinary. If you followed the news, I'll get into that in a little bit, but they've lost some subscribers and they were expecting to have a huge subscriber boost. They ended up losing, I think it was 200,000 subscribers. The point is, the stock is falling dramatically, and the question is it justified, and why has it happened? And as Mr. Valuation, this gives me a great opportunity to talk to you about why, valuation is so important, and also how high valuation and highly valued stocks can also be so dangerous. Because when a stock is really trading at a high valuation, especially an excessively high valuation, it becomes very vulnerable to any type of bad news. So let's go ahead and get into the stock, if we will. And, this is Netflix, and I want to also take the opportunity to provide some teaching moments to the Fast Graph subscribers here. This is what Netflix looks like from a standpoint of our max chart. But you notice we have no growth rate, and I have a 15 PE multiple here. So when you're using this tool, it's all data driven and it's all mathematically driven based on organizing that data in terms of growth rates and valuations and so on based on those growth rates. So the first thing you got to do is, I've got zero growth rate showing here because I have a lot of negative numbers here that I really can't show. So the first thing I'm going to do is shorten the graph to a 20-year graph. And now I get a growth rate of 30.12%. And that's going back to 2005. But here's what I want you to notice. This stock has been, based on a PE ratio equal to the growth rate of 30.92, which is what we're showing here. We're using the PE equals growth rate formula. The stock looks like it's been overvalued. The normal PE has been almost 100. And that's, really a ridiculous valuation, obviously. Recently, the valuation has fallen dramatically. But let's shorten this time frame again because we have some, really wacky years here. So let's bring this down to something more realistic. Let's go to 12 years. Actually, let's go to 13 years. And what I'm doing is I'm including 3 years of roughly estimate data here, because we're 1 quarter into the 2022 year. And now I've still got about that 30% growth rate, 29.84. So I'm using the valuation of 29.84 PE ratio. Again, P equals growth rate. And you can see that it was overvalued. And now all of a sudden it looks like, hey, after this correction, Netflix is coming to fair value. But this was a price of 348, which was where it closed yesterday. Okay. And as I pointed out, the stock is down precipitously today. All right. So to go into Google Finance again and show you that, has fallen 36%, roughly 35.59 to 224.53. So the stock is really falling and falling dramatically. Now you can see what it's done in a year. You can see what it's done in 6 years. And you can also see what it's done, as I showed earlier, historically. But the problem with these price graphs is they don't give you the perspective of price in relationship to the company's earnings and the company's earnings growth achievements. All right. So this company was vulnerable to any bad news. Now, analysts were expecting about a minus 3%, growth rate. They were expecting earnings to come in at 1087 this year. Okay, let's see if that's changed any and how much it's changed. So if I go look at it now, the analysts were saying 1087. Okay, that was before today's news. And then they were saying 1409 and then 1844 going forward. All right, now what's happened here is they reported earnings and they lost the subscribers, and it really created a lot of havoc with the company. So I went into our data provider, FactSet, and they've already got some modified numbers. The 1087 has gone to 1080. The 23 estimate's down to 1212, and then down to 1489, and so on and so forth. So these estimates have fallen rather dramatically for the company. Now, I don't have that data in the fast graphs yet. It's being loaded probably as we speak here. It'll show up, I'm hoping, by tomorrow, and no later than the next day. But the reality of it is you're going to see that, the earnings estimates for Netflix are being adjusted down, and they're being adjusted down based also on company guidance. Okay, so what I have the advantage of doing is I can go into the fast graph tool and I can go into the custom calculator. So what I've done here is I've gone in and I put the current price, I put $220. It's now, I think, $224 when I showed you last time. So this is from, the chart that we currently have. So if I go into the chart that we currently have, where the stock is trading at 348, and I'm showing, the high earnings growth here that was originally anticipated. I don't have it loaded in there, excuse me. And I show the current earnings growth we have, with the 1087, the 1409, the 1814, and so on. It looks moderately overvalued even then. Now, what I've done is I've gone into this last point here, and if I click on that last point, I can type in the price, and I put in 220. And so now this lets me create with the custom calculator on fast graphs the current price-ish. I got it around 220. That shows how much it's dropping today as we speak. Now, it hasn't closed yet, so we don't know what the final number will be. But it still looks overvalued when you add the 1080, the 1212, the 1489, the 1638, and the growth rate drops down to about 14%, which implies a PE of 15, which is what we're using on the orange line. So technically, Netflix would have further to go. That means that you could have a loss on this stock, or at least no more than breaking even over the next 2.5 to 3 years on this company. And that's really because it was overvalued relative to its future performance. Historically, the company's earnings, did kind of track their growth rate. Okay, the company's growth rate in recent years, in 2021, they had an 85% growth rate, a 47% growth rate in 20, a 54% growth rate in December of 2019, 114%, 101, and so forth. So they strung together some really good years here, and that obviously, and rightfully so, I might add, got people excited about the stock. But those kind of growth rates are very, very difficult to achieve. Number one, they're very abnormal. And number two, the big culprit, I think, coming here now is that you've got to recognize that what's happening is that we've had a lot of streaming services come online. There's an awful lot of competition for Netflix, and it's become very inexpensive to switch from one to the other. And so the company's really, lost a bunch of subscribers, and now, their business looks iffy, if you will. Now, there's talk by management on their most recent call that, the consumers are using these large streaming services like Netflix, and they're also switching to other services, and they're also sharing their login with their relatives and friends and so on. So Netflix estimated they figured about something close to 100,000 people are using Netflix for free. That doesn't really bother me too much. That's not a big number. But the point is there's a vulnerability in a company like this. It doesn't really have a moat. Morningstar gives it a narrow moat rating, even though it's the largest streaming service, in the United States. And it's rapidly expanding nationally. They have a subscriber base over 130 million worldwide. It's still very vulnerable to losing that to other services like Disney and so on and so forth. There's plenty of other services out there that are attacking this model because companies that earn the kind of money that Netflix have been earning here become targets for other companies because everyone starts to salivate over that profitability. But what I thought was interesting, and I want you subscribers of FastGraph to recognize, you can go in here and you can simply, click on that and put the price in. I put the 224 in here now, and I just simply hit enter. And now that draws it, bringing it down to where it was. So based on yesterday's estimates or today, I wanted you to see what the current estimates are in contrast to what they're now, what they're changing in one day. That's why I did this prematurely, or I would have waited till tomorrow, because I wanted you to see this is what the picture is looking like today. And now after these adjustments, we're looking at a much lower forecast. And I guess I closed it here. But anyway, you can go into these calculators using the custom calculator, and you can go ahead and input your own data here. You can, where it was 1087, it's now 1080. So you can go ahead and input that data, just simply type it in, hit enter, and you can see it gets drawn. And I can go to the next year from the 1080, it's going to 1212. It has 1409. So I type in 12.12, hit enter, and you can see that drops it down to 12.12. The 18.14 is now 1489. So I will drop that to 14.89 and go ahead and put it in there, hit enter. And you can see that, the earnings growth drops each time I do that. And I go into 1638 as the new number. So I go from the 1913, type in 16.38. Now we're starting to get out here to estimates that are getting a little too far out for me to give much credence. But the point is, we're looking at much lower estimate numbers out there and a much lower growth rate going forward than what we were in the past. And the growth is all being adjusted by the tool. It's not perfect at this stage because we're obviously forecasting here and speculating. But the moral of the story is Netflix does not look undervalued any longer like it did, in the old historical chart here. When you looked at it, it looked like it was actually undervalued because these numbers are adjusting. The growth rates are adjusting. These numbers are no longer valid numbers. They're marked here as estimates for you. They're now considered to be much lower numbers as I've drawn here for you. And so Netflix still looks like it could have room to drop. And of course, we don't know the final story yet. This is the first preliminary. But I do want you to note when you go into the estimates tab, when you're using your fast graph tool and go into the forecasting tab and just look at the normal estimates, I want you to note here that the estimates have gone from 6 months ago, they were expecting 1296. Then they increased it to 1311. And then dropped it to 1089 pretty recently. Then they dropped it to 1087. And now, as I've shown you on this, new estimates, it's now dropped down to 1080. So these numbers do adjust. And you need to take that into consideration when you're looking at companies like this. But here's the moral of the story. This company has no dividends, as you know. It's a pure growth stock generating outlandish numbers. Common sense should have told you that those numbers are very, very difficult to achieve, and it would only take those kind of numbers continuing on in the future to justify the high valuation that the stock was trading at. At 348 close yesterday, it was trading at 31 times earnings. But it wasn't too long ago that it was trading at 90 and 100 times earnings, which was obviously really crazy valuation. So, don't just get caught up in the hype. Do some analysis and then apply some common sense and then try to run the numbers out to the logical conclusion. And if you get numbers, you can go into the custom calculator, as I did here in this presentation for you today, and you can go ahead and input your own data, because none of these numbers that I'm showing here are on the current that haven't been adjusted or accurate anymore. Anyway, I hope you got some benefit out of this. As Mr. Valuation, I felt it was important for me to bring the story of Netflix to you because, again, there's an awful lot of things going on in the company. There are some really excellent articles out there on sites like Seeking Alpha. I saw a site by a writer called The Asian Investor. Morningstar has a pretty good report outlining what they think is going to happen to the future. Netflix is going to try some advertising models to see if they can affect the loss of all these subscribers. So a lot going on here, but it's a very high risk, very high growth stock. And you can see that, things can change with these type of companies very, very quickly and literally a heartbeat. Anyway, it's been Chuck Carnevale saying, thanks for watching. I hope you enjoyed this little update on what's going on with Netflix right now. I've had a lot of people ask me about it, so I thought I'd go ahead and cover it. I also thought it had some great teaching opportunities here from the principle of valuation, talking about how valuation works and what you have to take into consideration. You can learn a great deal from the past. You must always invest in the future, and nothing compensates for comprehensive research and due diligence. There are no substitutes for, just thinking about the company, trying to apply rational numbers and rational thought, common sense ideas to your investment strategies. Always run the numbers out to the logical conclusion. Anyway, if you like this video, give me a like, ring the bell, subscribe to the channel, and try Fast Graphs. It's a very, very comprehensive and powerful research tool, and it's only getting better every day. We got a lot of good things, exciting things coming up for the tool here this year. So thanks for watching. I'll talk to you again real soon.